Today we're covering dividends, what they are, how they work, the key definitions you need to know, common mistakes beginners make, and how to spot dividend traps. At the end, I'll show you a really simple example so you can see what you'd actually get paid. My name is Richie, and I make super easy breakdowns like this to help people new to finance or that are young with real money skills. All right, so first you need the one sentence definition, because if you miss this part, everything else will probably be confusing, so just pay attention. A dividend is money a company pays to its shareholders. If you own shares, you can get paid. Think of it like owning a tiny piece of a local pizza shop. If the shop makes a profit, the owner might hand some of that profit to the other owners of the business. So in the stock world, that handing you money is called a dividend. Now here's a big question, right? Where does the money actually come from? Dividends usually come from the company's profits or from the cash the business generates. So not every company pays dividends. Many companies will reinvest everything back into growth. So they'll look at expanding or hiring or building new products or marketing, and that's where that money will go. Okay, so if that's where dividends come from, how do you actually receive them? Well, it comes down to timing. Most dividend stocks pay dividends quarterly, meaning every 3 months. Some pay monthly, and some even pay once a year. If you own the stock during the right time window, the dividend gets deposited into your brokerage account like cash. You don't even need to sell anything to receive it. It just gets deposited. Now, there's one date that matters more than all the others because you can own the stock and still miss the dividend. So here are the 4 big ones, including that one I mentioned. Date number 1, the announcement date. The company announces a dividend is coming. Date number 2, the ex-dividend date. This is the big one. If you buy on or after this date, you usually do not get the next dividend. Date number 3, the record date. The company checks who the shareholders are. And finally, date number 4, the pay date. The dividend actually hits your account. So if you want the dividend, you need to own the stock before the ex-dividend date. Now that you know how dividends work, the next definition is the one that confuses people and creates a lot of these dividend traps. So you're going to hear people talk about the dividend yield. All that is just the dividend compared to the stock price, that ratio. So here's an example. If a stock costs $100 and pays $3 per year, the yield is 3%. But here's the big trap, right? Sometimes a yield looks super high only because the stock price fell a ton. That can happen when a company is struggling. So a high yield is not always a good sign. It can actually be a warning sign. So here are 2 quick checks you can use to see if it's safe. Check number 1, the payout ratio. This is the percent of profits a company pays out as dividends. If a company earns $10 per share and pays $9 in dividends, that is a 90% payout ratio. That is super hard to keep up during bad times. But if that same company earns $10 and pays $3, that is a 30% payout ratio. Usually, that's a lot more wiggle room, and they can keep paying even when business is down. Here's check number 2. Can the business keep generating cash? Dividends come from cash. So if the company's cash flow is shrinking, their debt is rising, or the business is clearly struggling, a high dividend can be a big warning sign. Remember, the goal is not the highest yield. The goal is a dividend that you can count on for years to come. So why would a company pay dividends instead of using that money to grow? There's a few reasons, and they all kind of loop together. Reason number 1, they generate a lot of cash. Some businesses make consistent cash and do not have a million great ways to spend it. Reason number 2, they are mature companies. A brand new company is usually trying to grow fast, so they reinvest everything. Mature companies often grow slower and can afford to pay the owners on the back end. Reason number 3, they attract long-term investors. Dividends can attract people who want more stability in income, which can create a shareholder base that is much less likely to sell during panic times. Reason number 4, it can signal confidence. If a company can pay and raise dividends for years, it can be a sign that the business is strong and predictable, attracting more investors. And reason number 5, it forces discipline. If management commits to paying shareholders, they often have to be more careful with internal spending. And this all leads to a huge misconception. The best dividend stock is not always the one with the biggest yield. A lot of smart dividend investors care more about a dividend that grows over time than a dividend that is massive today. So here's an example of that. A company paying 2% today, but raising every year, can become a bigger income stream later. A company paying 10% today might cut it next year, and you'll be out high and dry. So when people talk about those top dividend stocks, what they usually mean is just consistency. And there are 2 labels you hear a lot of. The first is Dividend Aristocrats. These are companies that are in the S&P 500 and have increased their dividends for at least 25 years. The second are Dividend Kings. These are companies that have increased dividends for 50 or more years. Now remember, this is through pandemics, inflation, recessions, and war. So they're super stable companies. Now I'm not saying you should buy any of these specific stock. The point is these lists exist because consistency matters a ton when it comes to dividends. Now most beginners shouldn't even be looking at individual dividend stocks. There's a very simple solution for you. You can use what's called a dividend ETF. An ETF is like a basket of stocks. Now, these dividend ETFs can give you a lot of things, right? Diversification across many companies. Usually they're way more stable than picking one stock, and it's just a simpler way to get dividend exposure. And if you want dividends to actually build into something meaningful over time, this next concept is huge. It's called DRIP, D-R-I-P. It just basically stands for dividend reinvestment. Instead of paying you cash, it automatically uses your dividend to buy more shares. That means more shares leads to larger dividends, which can buy even more shares, and it's just compounding. Now, before you get too excited about dividends, you need to avoid 3 mistakes that totally wipe out beginners. Here are those 3 common mistakes. Mistake number 1, we already spoke about this, chasing the highest yield. Remember, it can be a trap. Number 2, thinking dividends are free money. Dividends come from the company, and the stock price can move. Number 3, ignoring total return. Dividends matter, but if the stock price tanks, then all of that money that's tied up in that has halved as well. So how much of your portfolio should be in dividends? Here's a very simple beginner approach. Now, it depends on your goal, but if you are young and focused on growth, you usually do not need to prioritize dividends. You can still own dividend stocks, but you do not need to build your entire portfolio around them. Now, if you want income now, dividends matter a lot more, but usually that's for retirement. A simple approach for many beginners is make broad investing your foundation, like something like an S&P 500 index fund. And if you like dividends, add a dividend ETF as a very small slice. And to make that smaller slice more real, if you really want them, an example could be 90% broad index fund and maybe 10% dividend ETF. That gives you dividend exposure without making your whole strategy depend on dividends. So one last thing before the example, taxes, because the dividend you see is not always the dividend you keep. Some dividends are called qualified dividends. These are usually taxed at a lower long-term capital gains rate. Others are ordinary dividends, which are usually taxed like your normal income. So the beginner takeaway is this: if you hold dividend investments in a regular brokerage account, taxes can reduce what you actually keep. If you hold them in a retirement account like a Roth IRA or a 401k, you usually avoid paying taxes on dividends each year while the money stays in that account. Now, I'm not telling you what account to use, just understand your dividend yield is not the same as what you actually keep after taxes. So now that you fully understand dividends, let's end with that example. Now, this is going to be super simple, so just follow along. Imagine a company pays a dividend of $1 per share per year. If you own 100 shares, you get $100 per year. If they pay quarterly, that might show up as $25 every 3 months. Now, if you turn on DRIP, those dividends can buy even more shares, which can grow what you get paid over time. But remember, dividends are not guaranteed. A company can raise the dividend, it can keep it the same, or it can just cut it if the business gets really bad. Now, just a quick disclaimer to end this. This is educational. It's not pure financial advice, but if you do have a certain situation you'd like to go over with somebody, just reach out to a financial advisor and they'll be able to help you.